Welcome to Market Matters, our markets podcast on making sense, the hub for JP Morgan corporate and investment bank podcasts. In each episode of Market Matters, we discuss the latest news and trends shaping markets today.
Hi, I'm Eloise Goulder, head of the Data Assets and Alpha Group here at JP Morgan. Today, I'm delighted to be joined by Maxime Carmignac, who is CEO and Director of Carmignac UK Limited. Carmignac is a family-owned asset manager with a footprint across Europe. And Maxime sits on the board of Carmignac. She leads Carmignac in the UK, and she's also responsible for strategic product development within the firm. So, Maxime, thank you so much for joining me here today.
Thanks for having me.
The topics that I'd really love to cover together today are your focus as a fundamental discretionary active asset manager and where there are real benefits in your mind to having the man versus the machine, having the human at the heart of the investment decision rather than the data. I'd also love to touch on ESG as a topic because I know that you are 100% integrated in your own words and you use ESG as a backbone to many of your investments. I'd also love to touch on the end investor that you're servicing, which is ultimately the retail investor. So Maxime, could you start by setting the scene and introducing yourself and your firm in your own words?
Thank you, Eloise. So, Maxime Carmignac. I've been working at Carmignac since 2006. And previously, I worked in M&A at Morgan Stanley and also consulting at McKinsey. Today, I'm leading the product development, sponsoring ESG, investment solution, and strategic diversification on top of running the UK office. So, as you said, Eloise, Carmignac is a family business, which is actually quite rare in the asset management world. So indeed, the company was set up by my father almost 35 years ago. Thanks to our family status, we are independent, and therefore it also gives us the luxury of time. We're not like a publicly listed companies with quarterly targets having to meet a mother's company's strategic objectives. We have one and only objective, the long-term investment needs of our clients. And something also which is, I think, set us apart, and it's like all thanks to my father, he has a DNA of democratization of the best possible product to retail investors. Indeed, most of our client base are retail. It can be through intermediaries, so B2B2C, but it's still retail investors.
That's so interesting. And it's actually a theme that comes up in a lot of our podcast conversations on this channel. What I call it is the democratization of content and intelligence to the retail investor. But I guess what you're talking about is the democratization of investable products to the retail investor. And the fact that philosophically, this sounds like it's very important to you. But it's also a trend that seems to be happening anyway, given more and more online and social media type platforms, which are providing access to more intelligence for the retail investor.
Yes.
So you're an active manager and you focus very much on independent and proprietary research. So how do you go about ensuring that this intellectual honesty is upheld from your portfolio managers?
Yeah, indeed. We are not trying to compete with a huge quant and CTAs. We know what we can do, what we cannot do. Therefore, we are focusing then on the human value add work and to go deeper, to do the extra mile in order to understand corporates better than the market. And one thing we've been doing in terms of hiring is to hire hardworking analysts, but also from the private equity world, that they won't left any stone unturned. And I think now we are seeing like polarization in the industry. Either you compete on scale, on data, and on quant, including ETF, or you thrive as a boutique doing the extra mile at some specific niches where you can focus. And I think one example of that is ESG. It's very interesting in ESG now because in Europe and actually even more in the US, around 50% of the ESG flows now are passive. And actually, those 50%, 80% of them rely on MSCI data. So 40% of ESG flows rely on MSCI data, which we don't think over the long term makes sense and is in the best interest of clients. That's why, I think that ESG is a good example where you need to have a human being looking at a company, talking to the suppliers, competitors, analysts in order to do the extra miles and go beyond this pure tick boxing MSCI quant data to understand whether or not this company, ESG-wise, is well positioned and will perform over the long term.
That's fascinating. And we hear a lot, particularly on our data-driven podcast series, from the more systematic investors. It sounds like the other end of the spectrum to you, investors leveraging very large data sets with complex machine learning and quantitative tools. So it's fascinating to hear from you and your firm, which is very much the other end of the extreme, going the extra mile, as you say, deep diving, using human intelligence and intellect and experience. When you think about how can the human have edge over the machine, what's your answer to that? Is it the fact that they are focused on just a few companies and going really deep into those companies? Or are there other sources of edge?
Yeah, it's a great question because indeed, on the bottom-up corporate side, for credit or for equity, indeed, we do the extra miles and we try to understand the companies better, the management, and also the fact that we are a family business and that we are long-term oriented means also that we can build long-term relationships with the management. And therefore, we have this open line of conversation. But one thing also in terms of combining data and human value add, as I say, we don't try to be good at everything. We want to be the best at some specific niches. And we have picked 2 specific niches as it comes to data and quant. One is about human experience and one is about family business. So about family business, we mentioned it. I experienced what I call the family business magic, this extra mile, this collaborative mindset. And I had this feeling, but it was just an intuition, that well-run family business will overperform non-family business. We hired a quant actually from FactSet, who was responsible before for the database of voting rights at FactSet, the global leader. And together we worked for more than 1 year with pure quant, pure data to see whether or not family businesses will overperform non-family businesses. And I had just an intuition, and indeed, looking at the numbers, the data, indeed they do. But which is interesting is that in terms of top-down and analytics, is that they overperform, but actually you have some clusters. For instance, they overperform only in developed market, not in emerging market, mostly from governance reasons. They overperform in some sectors such as healthcare, consumer, financials. They tend to underperform from other sectors such as oil and gas and mining, for instance, and utilities. And also it depends also of the percentage of voting rights. If the family has below 10%, you don't feel the family effect, so no overperformance. And if the family has above 80%, then they tend to ignore minority shareholders. So you have a sweet spot between 10 and 80% of voting rights. And also in terms of generation, we understood that the family magic works from the 1st to the 5th generation. And after the 5th generation, most of the time you lose the skin in the game effect, therefore not overperformance. So this is what we've been working on, and we created Carmignac 500 database referring to the Fortune 500, which focused only on the family businesses. And we have now lots of data since, I think, 1975. In order to see which kind of overperformance you can expect depending on your segments.
That's really interesting.
The second thing we're focusing on is what I call human experience. I'm looking at companies where both employees and customers are happy. And if I had told you that 5 years ago, Eloise, I think I would have sounded quite vague and wishy-washy. But I think that the beauty now is we have much more data and quality of data. You can see, of course, of the rise of social media, Google Plus, and all these reviews, TripAdvisor, and so on. And now, the second most important criteria to buy after pricing now is online reviews. So you have this exponential growth of data, and therefore now I think that as an asset manager, we are able to gather the data, to clean the data, and to have strong analytics and see in a pure quant way which are the company best ranked in terms of employees and customers. For instance, YouGov now provides daily data of customer satisfaction. Again, I had this strong conviction, and we did back testing, and we noticed that those companies unsurprisingly overperform happy customer, happy employees. And so it's a virtuous circle, because good products, good companies, then your company is doing well, so you can hire the best employees. We will do their best for the customer. So it's a very good positive dynamic. And I also created a fund which I called Human Experience, relying on those data.
Absolutely fascinating. Thank you for all of that. Well, you covered so many points there. I think you've really touched on the importance of a family-run business and the benefits of that. And related to that, all of your research around the outperformance of family-owned businesses under certain criteria, like the family needs to own more than 10% of the shares. And then you've spoken to another really interesting theme, which is the man versus machine, human versus systematic. And it sounds like while you see major edge in the human doing the deep dives, you are still leveraging data in many ways. You're leveraging natural language processing. You still do have a place for data and systematic and quantitative techniques, but it's not the be all and end all by the sounds of things.
Yes, absolutely. As you say, Louise, no, we have to be very humble and we'll never compete with the data and quant giant. But what we want is to focus on some specific niches. Then our value add is to analyze the quality and quantity of data and to pick the best possible with the best relevance in terms of price action.
Brilliant. Thank you. So I wanted to pick up on the topic of ESG, and you spoke there about the fact that so many passive funds now use ESG, and of those, I think you said 80% rely on MSCI data. So there's definitely a risk there that they're all looking at the same thing.
Absolutely, yeah. Overcrowding, yes.
Overcrowding, not necessarily proprietary. What's your view on the ESG space as a whole? What are you trying to achieve by having an ESG lens? Where do you think we as an industry are doing things well? And where do you think we need to improve in this domain?
Yeah, it's a fascinating question. I think that first we are in the infancy, in terms of combining ESG and asset management. I think that an asset manager, in the context of lack of disclosure from corporates, in the context of absence of clarity from regulators, and also changes of ethics stances from investors, for instance, before Russia, defense was bad. Now we talk about security. Nuclear was bad. Now it's good. So it's still moving past. So in this difficult context, I think as asset manager, our role is to be very transparent in our process and our criteria in order to empower our clients, depending on their own ethical stance, to allocate their capital. So we have to be very transparent. We have to be very humble. Also, why humble? Because, even if you look at the CO2 emissions, only less than 1/3 of global CO2 emissions come from public companies influenced by investors. You have those national companies and you have all the different CO2 polluters. So I think that being serious, being humble is very important. Yes. And the way we've done it at Carmignac, and coming back to your data point, we have created our own tool, which we call START, which has two legs. One, pure quant data. We are using 38 different data points from 9 different data providers, which automatically provide the base for each company we invest in. So we look at ESG before investing, because this is part of our investment process for 100% integration. We prefer to address the companies that are not necessarily the cleanest today, but that are going to the right direction. We can engage with them over the long term. Because as Bill Gates has said, divestments to date has saved about 0 tons of emission. You don't want to invest only in the clean company today, because those companies, they don't need us. They are overcapitalized. They are well known already.
Yes.
You want to address when you can have the highest incremental impact.
Yes, no, that makes sense. And you spoke at the beginning about the democratization of products to the retail investor and the importance of the retail investor as a customer base for you. And now you're speaking about ESG, and I think you said 100% integrated. So this idea that all portfolio managers look at ESG as one criteria of many when they decide whether to invest. I'd love to understand your perspective on the retail investor's views on ESG. Yeah. Do you find that the retail investor cares deeply about ESG, and has that changed over time?
Yeah, it depends. I think there are two big points. The first one, because at Carmignac, we have offices in Italy, Spain, Germany, Switzerland, Belgium, France, on top of the UK. And I spend lots of time visiting my clients. And this summer, I visit my 6 offices this summer. And there is a very big difference, if you go to Germany, Belgium, compared to South of Europe, So I think that there is a time of lag, South of Europe versus North of Europe. There is a much higher interest in North of Europe today. So it's very interesting to see, depending on clients. But I think in terms of retail, as you say, the big difference is age, generation. The younger investors, they are much more focused in terms of ESG. That is the old generation.
Yes.
So which is very promising in terms of ESG, because demographics will help, it's a tailwind. Yes. But indeed, like you cannot say that everybody is investing in ESG. It would be a lie. What I noticed the most is huge top-down pressure from large corporates. It comes from the top management and the board, and it's got to infuse into the whole company, But for me, ESG is not a silo or it's not a top-down wishful thinking for the top management. For me, it's like a tea bag. It has to infuse the whole organization. And that's what I'm doing with my clients, and I'm very happy about that.
Yes, absolutely. You mentioned earlier when I asked about the benefits of discretionary investing versus data-driven systematic investing, one of the benefits is that your portfolio managers can spend a lot of time with company management and they can really understand the company, perhaps from a different dimension than a systematic investor purely looking at the data around that company. Do your portfolio managers then have the ability to influence management in any way?
It's a great question, especially to differentiate from passive. Again, because we are long-term investors, we build the long-term relationships and we can do engagement. So we engage with the companies in order to go with them towards the right ESG direction. So depending on our relationships and relative size as the shareholders, either on the equity or the debt, we try to do our best to influence the company.
Thank you.
About family business, there is a quote from a French author, which I loved. And it's a good way, I think, to combine ESG and family businesses, because Saint-Exupéry in The Little Prince has said, you don't inherit the planet from your parents, you borrow it from your children. So it shows you that this intragenerational purpose. And if you translate that to a family business, you say you don't inherit a family business from your parents, you borrow it from your children, which shows you like how long-term you have to focus and this huge luxury of time that you benefit from.
Incredible. Well, I wanted to ask you a little bit more earlier about what really are the benefits of the family-owned business. And I think you spoke to the fact that you need to have this true ownership culture. When you go to work, you own the business, you deeply care about the outcomes.
We call it skin in the game.
Skin in the game, exactly. But equally, the long-termism must be a fundamental factor driving so many family businesses. The fact that you are working for future generations, your future generations.
Yes.
Brilliant. Well, we've covered so many topics here. I think we've covered the benefits and the advantages of family-owned businesses and employee-owned companies. We've spoken about the retail investor and not only the democratization of content, which I so often go on about, but also the democratization of products available to the retail investor. And then we've spoken about ESG and your view that ESG should be 100% integrated into the investment process, and the relationship between the retail investor and ESG, and fascinating to think over time of these younger generations caring more deeply about these topics, which is absolutely a tailwind for the theme of ESG. And then we've also spoken about data-driven investing from a fundamental discretionary lens, and the fact that data is still critical and you do try and leverage it where relevant, for example, in measuring the human experience via online reviews and that sort of thing. So absolutely fascinating to hear your perspective on all of these themes, particularly because it's quite different to the perspectives I hear from systematic portfolio managers, for example. So could we turn now to the UK? You're obviously CEO of Carmignac UK. You're a European business, so I'm fascinated in a post-Brexit world that you have a deep footprint here in the UK. Can you speak to why you feel the UK is an important market for you?
My father and I, we always say, if you can make it here, you can make it anywhere, in the UK, because it's a very competitive market. And it's also a fascinating market, because I think that the UK is much far ahead in terms of tech and regulation compared to continental Europe. Like in the UK, 15% of the flows are D2C, thanks to also the fantastic growth of platforms. So I think this is far ahead of continental Europe. So we have to learn from that. It's super interesting.
So just to clarify that, 15%
of the asset management industry is done
direct to the consumer.
Direct to the consumer, whereas only less than 5% in continental Europe. So this is a huge gap. And I think that this is a history, to have more like direct to consumer. So we are learning from that. And also in terms of regulation, we had in the UK, the Retail Distribution Review, RDR, as early as 2013, whereas in Europe, you had to wait for MiFID, So we are learning also in terms of regulation and also in terms of talent. This is fascinating because when I joined Carmignac in the UK, there were like 4 of us, now 65 of us. And it's also thanks to the huge talent attractiveness in the UK. Despite all that we are seeing in terms of Brexit, we are still able to attract top talents in the UK that would not have necessarily accepted to go to Paris. And also the size of the market, in terms of retail investment, the UK is larger than France and Germany combined for us, addressable market. So this is a huge opportunity for us, but this is a difficult one, indeed, because it's a very mature market and a very competitive market.
Wow. So you've gone from 4 people in your UK branch to 65 people today. And it's just now become a subsidiary.
Absolutely, yes.
Thank you. So really interesting landscape, the investing landscape in the UK, the fact it's more competitive, the fact it's more mature, the fact that direct to the consumer is that much higher, more digital, as you say. What about UK equities and UK markets as a whole? Is your UK business also disproportionately investing in UK assets?
It's a good question. Actually, not. We just want to find the best possible countries given the specific geopolitical context. So it depends, I will say, on the years,
Yes.
But something we have done specifically to the UK is to create a fund which is called Carmignac European Leaders because it's a European ex-UK long-only equity fund. Why? Because UK investors, they like to do their own UK asset allocation themselves. Therefore, they want a building block, which is the best of Europe without the UK. And this is a product we created more than 4 years ago. And this is for us, like I will say, a UK dedicated product.
Yes.
Even if there is no UK inside. It's quite paradoxical, but that's the way it works here. So we have to adapt to the market.
Wonderful. Well, we've covered so much, Maxime. So I guess before we go, my final question for you would be about your views on the industry at large and the way the industry is changing, particularly your part of the industry, which is active investment management. Has the skill set required changed over time? Is the investing opportunity set different today? What are your thoughts on the future of the industry?
Yeah, I think that this industry now is facing lots of changes. We have this triangle between a tougher regulation, higher competition from ETF, and also technological disruption.
Yes.
So we are clearly being disrupted as we speak. So I think if you look at the long term, only the best will survive. But it's clearly a challenge. I see a polarization between the largest ones competing for scale from cost and the niche one, like some boutique. We are working hard to differentiate themselves and provide something special to their clients. If you're in the middle of those two trends, you're going to be squeezed and you have started to being squeezed, and therefore we've seen lots of consolidation already. This summer, for instance, PwC say that 1 out of 6 asset managers will disappear by 2027. I think this is happening already, but there are also some bright side. We discussed ESG.
Yes.
Even if it's quite still awkward today, I think this is fantastic, as a young leader like me to be able to have an impact on ESG. This is like a blank paper, like in virgin territory. So this is fascinating, the impact you can have, even if you have to stay humble. And something also which is a positive change, I think, is diversity,
Yes.
And I can only be grateful for all the efforts that are being done for women in the professional world. I think that I can only admire, for instance, what Sheryl Sandberg, the former CEO of Meta, has done, with the lean in. And I will encourage any woman, actually any man, because she's a great business person, to read her book, to lean in, to ask for the next internal mobility, salary increase, promotion. This is something that doesn't come always naturally to women. So this is like for the professional world. But for me, I think that Eloise, the most fascinating part as it comes to gender diversity and men and women inequalities is women as investors. Because I think there is a huge investing gap. And today there is a lot of attention in terms of women as professionals, which is great, of course. As far as I am concerned, not enough attention for women as individuals, the empowering woman financially, because a woman who is empowered financially is independent and therefore the life is much, much easier, And I am shocked to see this gap in terms of financial education between men and women, it comes from the family, it continues at school, and also the media, the press, there is not enough attention spotlight on women as investors and education. My concern is that women in general are much less aware than men about this power of compounding. It is very unfair, and I think that what makes my heart beat, on top of my company, is to try to reduce, this huge inequality and to make this power of compounding more obvious to women. So to raise awareness on this power of compounding. And also last thing is to also provide women with products that fits their needs better, because there have been some fascinating studies, including some from JP Morgan, by the way, which show that women and men in general, they don't have the same expectations as it comes to finance. Women are more interested in the why should I invest versus men, the how do I invest. I think you need to provide women with a very simple and transparent product with high sustainable criteria as well, with more long-term focus.
That's absolutely wonderful. I love the points you're making. There's this focus on women in the workplace and women in their professional careers, which
is great,
which is fantastic,
of course,
and we
which is necessary. Yes,
we shouldn't downplay that.
Yes.
It's critical, and I think we both believe strongly about that. But there's women as investors, women who are starting their compounding journey early, women who are building up their pension pots from a young age. That's
Absolutely.
what we really need to be striving towards. We've come full circle really to the retail investor and the importance of serving products to the growing retail investor, but also in theory, the more informed retail investor because of availability of information.
Absolutely.
And females should be just as much the retail investor as males, and providing products that they want to invest in. Excellent. Thank you so much, Maxime. It's been a really interesting, inspiring conversation. Thank you so much for taking the time.
Thank you, Eloise, for your questions. I think it was super interesting and we covered a lot. And I get lots of numbers because I know you love numbers and I do love numbers too. So I hope it will not look like a geeky conversation.
They're the best. They're the best. Thank you so much.
Thank you.
Thank you also to our listeners for tuning in to this bi-weekly podcast from our group. If you'd like to understand more about Carmignac or the things discussed by Maxime today, then do take a look at our show notes. Otherwise, if you have further questions, do go to our team's website at jpmorgan.com/market-data-intelligence. And there you can always send us a message via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.